Edward, great to see you here on The Money. Thanks a lot for joining us. It strikes me that the main thrust of your book is that whenever we have particularly low interest rates for an extended period of time, we end up with lots of financial turmoil. Well, interest rates have been very low for an extended period of time.
Well, that is part of the main thrust of the book. And I cite the great Victorian financial journalist Walter Bagehot, who made this comment that John Bull can stand many things, but he cannot stand 2%. And what Bagehot means by that is that when interest rates go down to 2%, people need a bit more money, so they start speculating. They start doing impossible things. He said the burghers of Amsterdam started buying impossible tulips. They make canals to Kamchatka, sell ice skates to the torrid zone, and so forth. So what we see from the 19th century, and I thought actually you can trace it back even earlier than that, is that the periods of easy money are associated with the build-ups of great speculation and then financial crisis.
Many people will recognise what you just said and relate to it. You know, pensioners saving and getting what we call negative real interest rates. When the interest rate is less than the rate of inflation, you're losing money in real terms on your savings. And by God, the interest rate's lower than the rate of inflation at the moment.
As you know, interest in recent years has been lower than in 5 millennia of history. The advent of negative interest, a sort of tax on savings, has never been seen before. And savings, interest is, after all, an inducement to save, but also a return on your savings. So the era of negative and very low real interest rates has actually damaged pensioners and savers tremendously.
I must say, and I'm not just saying this because you're in front of me, it is a personal pleasure for me that you've written this book, The Price of Time, The Real Story of Interest, because I have, as you know, in my columns, been banging on since the 2008-9 financial crisis about the dangers of ultra-low interest rates, about the dangers of so-called quantitative easing, this massive expansion of central bank balance sheets. It strikes me, Edward Chancellor, and I wonder if you agree, that in the aftermath of that financial crisis in 2008, when it looked as if, you know, a lot of the world's banking system was about to collapse, ATMs were about to stop working, that would have led to civic unrest, riots, you know, proper breakdown of society in some parts of the world. It strikes me at that time, emergency measures were justifiable. Quantitative easing, the expansion of central bank balance sheets, ultra-low interest rates were justifiable. But then what was meant to be emergency medicine became like a kind of lifestyle choice.
It was a drug. And we took the drug for 12, 13 years. And the more we took it, the more we liked it. And you saw that with the great money printing during the COVID lockdowns, with massive growth in the money supply and lower interest rates than ever. Now, go back to your early qualms about quantitative easing, central bank money printing.
There weren't many of us at the time who were questioning it.
I know, but we got it slightly wrong, because initially that money remained, so to speak, trapped in the financial system. But the central bankers then became complacent and thought the money would always remain trapped in the financial system. So then they started financing and directly financing the governments. And it's the moment they started financing the governments and the distribution of government payouts to people who were staying at home doing nothing, that they actually caused tremendous surge in demand. And that creates the conditions for a classic inflation. So I think, you and I were a bit early. From my perspective, it gave me a long time to work on this book, because I knew some big problems were building up. And in a way, COVID came along and the lockdowns came along just as I was sort of finishing off the book. And I could tell already, at the time when the central bank was saying there was no inflation around, that they'd already unleashed the inflation into the system that was going to bring this to an end.
I think the thrust of what you're saying, and it's something that I agree with, I've written it in the past, that pre-COVID QE, much of it did stay within the banking system. Some of it went out into the housing market and it blew bubbles within equity markets and bond markets, but it didn't get into general circulation. But post-COVID QE is that money is much more out there and much more likely to cause inflation, right?
Yeah. Absolutely. So it took a long time. And in fact, actually, in the book, I cite an economist in the 18th century was following John Law's Mississippi bubble. John Law was, as I say, is the first instigator of quantitative easing. And the economist, banker, Richard Chancellor, says, well, the central bank buying bonds doesn't cause any problems at first because the money is trapped. But these are dangerous operations that are like a bomb that eventually goes off. There is no escape. And what we've seen, and over a more protracted period, so 13-year period, is there was no escape from the quantitative easing. There was no escape from the negative and zero interest rates. And the only escape, I'm afraid, has been the onset of what looks like a new crisis.
Edward Chancellor, you're a very learned and highly respected financial journalist. It strikes me that you're saying that we've set ourselves up for a crash with this endless quantitative easing, with these ultra-low interest rates for an extended period of time. Is that what you're saying?
Well, yes, I am. And I'm sure we've all written about it in the past, that after the financial crisis, we talked about the central bankers and policymakers kicking the can. They didn't want to deal with the problems. They wouldn't even acknowledge the source of the problems of the financial crisis, which, after all, came from the very low interest rates that the Federal Reserve instituted in 2001. They denied it was anything to do with easy money policies under the Greenspan Federal Reserve and under Ben Bernanke. They said it was just liquidity crisis and so on. So what we did is we had a sort of hair of the dog that bit you. Well, if you're going to have take the hair of the dog, you're going to wake up with an even bigger hangover at some stage in future. And I think we haven't quite got there yet because the penny hasn't completely dropped. But as you see, the stock markets are down 20% plus. The housing markets, which you've written about, driven into bubble levels all around the world by these ultra-low mortgage rates. They're beginning to falter. The cost of financing a US mortgage now has doubled in the course of this year. So you're going to see these housing bubbles beginning to deflate, financial asset prices coming down, and then I think probably debt problems surfacing. So it's sort of a sort of slow motion train wreck of the type that we saw in 2007 onwards.
So the logic of your position, Edward, and I say again, you are a journalist, a financial analyst of extremely high repute. So the logic of your position is sell all your shares if you've got any, and if you're a person under 30 waiting to buy a house because it's unaffordable, wait a bit more and soon they'll be cheaper. Is that what you're saying?
Well, you're putting some words into my mouth. There are some markets where, we won't go into the details, but some parts of the world where equity markets are reasonably cheap. I'd say, Japan, for instance. Parts of Europe, but that Europe has its own problems, parts of the emerging market. So I wouldn't say get rid of all your equities. In fact, again, as you know, equities over the long run provide an inflation hedge. They just tend to take a bit of a down hit during inflation.
It's all about time in the market rather than timing the market, right?
Yes, but I would go back to your second point about housing. Yeah, I'd say to my nephews and nieces who have been priced out of the London housing market for the last 12 years and getting extremely irritated about it, to bide their time, because I think that prices probably will come down to the sort of level they were when we left university, and it was reasonable to expect that if you worked hard, you might be able to afford a flat.
We're unusual, aren't we, among financial journalists, you and I, among columnists, because we have been focused on these issues over the last 10 to 15 years or so, the dangers of lower interest rates, the dangers of quantitative easing. Do you think our so-called profession, it's more of a trade, isn't it, journalism, even financial journalism, do you think we've been guilty of complacency? Have we not held the central banks to account enough? Have we been too mesmerised by the money printing, the rising financial markets, the kind of hoopla of the age that we've lived in up until now?
I wouldn't necessarily blame the financial journalists alone. I think you have to say, to my mind, the problem lies with the economists, both the academic economists and the central bank economists themselves. They know nothing. One of the reasons I wrote this history of interest is it became pretty clear to me that the central bankers and the economists know nothing about interest. They've forgotten the function of interest, the deep and rich history of interest, and the vital functions that interest serves in a capitalist economy. I say in the book that capitalism without interest cannot function. It is, so to speak, the keystone that holds the system together. So yes, I think a lot of journalists don't really understand it. They tended to sort of take their lead from what the central bankers say. In America, if you can get the job of being the Fed watcher on the Wall Street Journal, that's a pretty cushy number, because you just basically...
But don't say anything that annoys the Fed. Don't say anything that annoys the Bank of England. I've been in journalism a long time, and I would say that journalists have been far too mesmerised by the central bankers. They have been far too slow to deploy the kind of analytical skills that you've deployed in writing this book and making the statements you're now stating.
Yeah, so the central bankers were probably given a free ride. And I think one of the reasons they were given a free ride is, first of all, as you say, they sort of patched everything up after the financial crisis. Do you remember Ben Bernanke, then chairman of the Federal Reserve, was made the Time magazine Person of the Year in 2009. And never mind the fact that he was largely the person responsible for the financial crisis. So people only looked at the way they'd patched things up. The other thing that I think people are beginning to understand more now is that the sort of inflation of asset prices following the low interest rates and the quantitative easing and so forth, that made a lot of people who owned houses, who owned stocks, particularly happy. I mean, what's not to like if your house is going up 10% a year and your equity portfolio is going up 15% a year? You're going to think the central banks have done a good job. The trouble is that when the system then all starts falling to pieces, you get inflation, rising interest rates, and the asset prices come down. You say, actually, hang on a sec, I wasn't as rich as I thought I was. In fact, not only was I not as rich, but I haven't saved as much as I should have saved. And then you actually then have some new problems, which is, hang on a sec, perhaps I can't afford to retire now, given that I'm not as rich. So I think when you get to that point, then everyone turns around and say, hang on a sec, these central bankers are sort of not what they profess to be.
And of course, you just described the possible dilemmas of people who had the assets in the first place. How about others who haven't? A whole generation of youngsters locked out of home ownership, as you say. Why should they support capitalism when they've got no capital? I mean, in the end, Edward, if the system, if smart, financially literate people who run central banks, who write in the kind of posh newspapers where you and I have written for our careers, if we can't solve these problems and provide a framework that allows ordinary people to work hard, keep hold of most of their money, and build a little bit of wealth and freedom for themselves, aren't we going to have a more systemic meltdown, a crisis of confidence in capitalism?
Yeah, I think so. Now, a chapter in that book is called "Let Them Eat Credit." I mean, there was a comment. I didn't make out that comment. It's from the former
Marie Antoinette, wasn't it?
No, it was the former governor of the Reserve Bank of India, Rajaram, and he said, if people are not earning enough, there's no wage growth. The other thing is that the very low interest rates dampen productivity growth, and that means dampening wage growth. It dampened the return on capital. That means your savings, and it made it harder to buy houses. So the cost of security, of healthcare, housing, education went through the roof. People, as you say, younger generation, had less interest vested in the system. So no wonder they went off to vote for Corbyn or whatever. I mean, in their position, I would have done the same too. It's immensely unjust what has happened to the younger generation through these policies. Now, I mean, the interest rates and interest may seem a bit obscure, but the real social and political consequences of what the Germans called Strafzins, punishment rates, are actually there for us to see. And I think, and I would link this to the rise of populism, just as the hyperinflation of Germany in the 1920s led to the rise of sort of political extremism in Germany. There we see these sort of nasty political consequences from monetary matters. And the trouble is, I'm afraid, that given that we're now at the stage of the inflation stage, that isn't going to go away. The inflation, as you know, is an expression of political discontent, but it also exacerbates the political discontent. So you would need very good policymakers, very good statesmen to try and navigate your way through this difficult juncture. And there's no there's no sign that I can see from any government, except perhaps the German government of the 2000s, Wolfgang Schäuble, the finance minister, who was constantly complaining.
He does get this stuff.
Schäuble did get it, but most of them don't get it. The government, the politicians themselves have very little inkling of the problems that have caused by monetary policy. They thought it gave them a free pass. As Boris Johnson said, the government wants to put its arms around you. Why not? If the money is free, but the trouble is the money is now costing a bit more, and the government's arms are not quite as long as he thought they were.
I think you're being overly generous. It's not only the politicians that don't get it. A lot of the so-called technocrats at the central banks don't seem to get it either. I mean, let me chance my arm here, despite your natural tact and politeness, Edward. What were you thinking as you watched for all of last year Andrew Bailey and the Monetary Policy Committee insist that inflation was transitory? I mean, anybody that looked at financial markets, anybody that looked at commodity prices, anybody looked at 5-year yields or spreads, the sort of thing that you and I look at on our phones when we're waiting for trains to come, it was clear there was inflation building.
Yeah, but I would go back even further to the beginning of the COVID lockdowns, when they locked down these societies. They dismantled or put their economic structures into the deep freeze and printed the money as if we could,
So demand went nuts.
Yeah.
The supply side was curtailed by lockdown. Inflation was inevitable.
It seemed, inevitable is a strong word to use, particularly when one has made sort of, let's say, inaccurate inflation forecasts in the past. But I thought it was in the pipeline. And then I think the central bankers and the politicians were extraordinarily complacent. But again, this is one of the reasons I wrote the book, is they didn't seem to understand what they were playing with. The economist Hyman Minsky, the maverick economist who became popular after the financial crisis, he was dead by then, but no one paid attention to him when he was alive. But he made this comment.
It's always a good career move in rock music and economics to die in terms of the popularity of your work.
Raise your reputation.
Yeah,
Anyhow,
it's what I'm banking on anyway.
Minsky said about... he said, no one up there understands economics. And I think it's a sort of bold claim for me to make. And bear in mind, I was trained as a historian, not an economist. But the more I've worked in the field of sort of financial economic history and economic thought, the more I see that a sort of what you might call a trained incapacity of the sort of modern policy-making economist. And I think that those people will learn. And I'm hoping that this book will provide, if it gets a broad enough readership, then questions will be asked that these people will need to answer. Their attitude in the past, Liam, and you'll know this as well as I do, is to just ignore criticism. They have a very arrogant approach.
Or even to vilify the people who are putting forward the criticism, however well qualified, Edward.
Yes, but they prefer them to be outside the system where they can ignore them. And I think now, go back to Governor Bailey at the Bank of England saying he confessed to being helpless. Now, when a central banker has made extraordinarily poor forecasts and has really sort of jeopardized the financial structure of the economy of the system, and then says he's helpless, then obviously people are going to have second thoughts and to think, what has he done and why are we in this mess?
Is the Bank of England bedeviled with groupthink, given that there seems to have been so little debate, almost a determination to not look out the window and to see what was going on for much of last year, and indeed quite a lot of this year too?
So you spotted that Andy Haldane, the very bright chief economist of the Bank of England, who had been mooted to as a potential governor until this, I don't know if one can call him a pen pusher, Andrew Bailey got the top job, and Haldane quit, and he quit because he thought the bank's securities purchases, its quantitative easing should come to an end. He said this, in the middle of last year, or perhaps a bit earlier. He said that the job of the central bank was to take away the punch bowl after the party got going, a sort of famous comment. And he said it was, that the Bank of England had failed in doing that. So, and that's, what happens if you sit in a committee with groupthink. The person who doesn't join in the groupthink is sort of pushed out of the group,
which is anathema to what independent central banking should be. We need some grit in the oyster. We need independent thinkers of caliber enough that they can have their independent thoughts and not be described as mad or vilified or pushed out.
Well, I mean, I wonder about independent central banking. Do you know that the Reichsbank after the First World War, the Reichsbank that was responsible for completely destroying the German currency, and that was an independent central bank created by the Allies, or institutionally created by the Allies after the First World War. So when it was eventually time to bring Germany's hyperinflation to an end, and the German government agreed to do so, the governor of the Reichsbank, called Rudolf Havenstein, he said, "No, this is my independence. You can't do this." And he actually died of a heart attack in his office on the day the hyperinflation came to an end. So I don't think you can put any trust in independent central banking. And in a way, if you go back to how it was in the mid-1990s, then when it was the Chancellor's ultimate responsibility where the interest rate are. Now then, at the moment, the Treasury, Rishi Sunak, can disavow any responsibility for what's going on. But in fact, actually, a political responsibility for what the interest rate policy is and its consequences, whether these ultra low rates and all those consequences, or whether the inflation, then actually returning the politicians to their responsibility would, taking back control, to use a phrase, might not be a bad idea. I don't think central bank independence has worked in this country.
Final question. I'd actually disagree with you on that, with all due respect, Edward. I think the problem we've got is that our independent central bank isn't independent at all, because the Monetary Policy Committee is dominated by Treasury civil servants controlled by Whitehall. I think independent central banking only works if it is genuinely independent. And if we lose proper independent central banking, we're very close to losing it now, and go back to politicized central banking, I think that would be folly.
Yeah, well, so perhaps we have neither fish nor fowl now, so we probably don't really. I mean, yes, a very good central bank. Or go back into the 19th century when you had a gold standard, you didn't really need an economist in charge of it. The Bank of England had a gold in its vault. When the gold left the vault, bank would stick up interest rates, the economy would contract, have a bit of a bust in the City of London, and then the ship would right itself. And in those days, they just had city merchants sitting on the court. There were no commercial bankers. There were not such thing as an economist. That was a sort of 20th century aberration to have economists at central banks.
Well, it's a very wide-ranging book. You've stuck your neck out and you've criticised the monetary authorities, Edward Chancellor. And I must say, I'm fully behind you when you do that. And it's been really interesting to talk to you. Thanks for joining me on Money Talks.
Thanks.